us right now, Schork Report founder Stephen Schork. Stephen, it's good to have you on the program once again. Tell us your feeling about the oil markets right now. Is this justified, the declines that we're seeing?
Absolutely, and we're now, Maria, at the make-or-break point right now. As I was here last week, oil on the NYMEX in New York between 47.22, 45.32. That is a key area of technical support. We have to hold it. Otherwise, we risk a flush down towards that $40 psychological barrier. So to answer your question with regard to the justification, absolutely, because what we've seen now was, well signaled, and as I've been telling clients in our daily report, that indeed, with regard to OPEC's decision in November, what has happened with U.S. production? U.S. producers have put 600,000 barrels more oil onto the market today than they were back in October prior to OPEC's announcement. So to a great extent, U.S. producers have offset this production. And when we look at the producer and what they've been doing, rig counts, oil rig counts here in the U.S. have doubled since the spring, rising in 10 out of every 11 weeks. Short interest, that is, the amount of futures contracts that producers have sold forward remain near record highs. A producer only sells a future contract when they intend to bring more production to offset that contract. So the signal is there that U.S. production is high and it is going higher. On the other side, Wall Street bought in to OPEC's rhetoric. In November and December, Wall Street speculators went on a buying spree and went all in betting on higher oil prices. They were wrong. In fact, at one point back in January, for every $1 the bearish speculator was risking, we estimate the bullish speculator was risking $12.
Yeah.
That was untenable.
Yeah, because
so
this is about OPEC,
now,
but it's also about policy. I want to get the panel involved here because we got more policy decisions out of the administration that will likely dictate markets. The administration's approval of the Keystone Pipeline. You would think that as we tap into the energy resources of this country, more oil in the global market means prices come down.
Yeah, and I think Stephen said that too. We're at a historically high level of inventory of oil, so we're just going to continue to...
Which just underscores you better get this economy growing and other global economies growing, or that oil is just going to pile up.
In other words, you're going to need the demand for all the oil that you're producing.
Yeah.
That's a really good point.
But one of the things that low prices does for oil, it does create demand, right? Because people won't drive the car, people won't heat the house when oil's too high, but when prices go down, they start using it again.
They won't buy the SUV. Yeah, for sure. Stephen, what do you make of that, the administration's approval of the Keystone Pipeline?
Oh, well, of course, obviously, I'm all for it because obviously what it does is it creates the whole change in animal spirits. And as the saying goes, capital is going to go where it is welcomed, and it's going to stay where it is well treated. And with what we saw during the last 8 years, with the political football that Keystone XL was turned into, this was a no-brainer decision that should have been made in Obama's first term, but it was dragged through his second election, and it was ultimately killed. So that was the clearest signal to our industry that capital in the oil and gas, the U.S. hydrocarbon economy, was not welcomed and would not be treated well. So with the move, the pivot with the Trump administration and improving Keystone XL, and it's not just Keystone XL, right? It's the decision announced by Exxon to invest how many billions of dollars into the Gulf Coast. It's Shell's decision sitting on a piece of property out in Pittsburgh, in the western part of my home state. Shell had the option to build an ethylene cracker there 6 years ago. They didn't make the decision until fairly recently. That's going to put 6,000 construction workers to work immediately and ultimately hire up to 700 people in that part of the state. So we're seeing a sea change in the environment that it's okay to be in the oil and gas industry, and capital is welcomed and it will be treated well. And it's a boom for the industry, which ultimately is a boom for the U.S. economy.
Stephen, this is Mitch Rochelle. One of the things I noticed with historical high levels of inventory is the reserve replacement ratio in terms of exploration is actually quite low relative to historical trends. Is that something you expect to reverse rather?
No, absolutely, because it goes into the adage that, and this was one of the fallacies with peak oil 10, 15 years ago, the fact that we haven't discovered any oil. Well, we didn't discover any oil during the 80s and 90s because who's looking for oil when it's averaging $17 a barrel? pumping it up to $150 a barrel, and all of a sudden we now have a problem of too much oil. So, of course, with the pullback in CapEx that we've seen over the past 2 years, there is going to be that concern with the pullback. But we just had a major discovery once again in Texas, another one in Alaska. When we got oil back up into that mid-50s, all of a sudden we're starting to look for it. So, yes, indeed, in the next year, next 2 years, I do expect that trend to reverse.
You know, one of the things that I keep seeing and hearing from voters out there is they're saying so much of the policy that's going through is helping big business, not necessarily the consumer, not necessarily the individual. And so when they see the pipeline going through, they're saying, oh, that's going to be great for Exxon and Shell and these big companies, but what's it mean for me? When you're talking about the border adjustment tax, oh, that might be great for business, it's not going to be great for me. How do you help people understand what this means for them, that this is going to benefit individuals as well as big companies?
Fair question, and let's go back and look at the State Department's environmental impact study on the Keystone XL. In the short term, the benefits are going to be, on average, the creation of 42,000 jobs, 4,000 immediately into the construction industry. That's going to create $2 billion in income, taxable income. We're going to see expenditures in these states of upwards of $3.5 billion over the next 2 years. And that's going to be, in a lot of these counties, their tax base is going to double in some of these counties as the construction camps are built and as the retail taxes increase. So it is a multiplier effect that, yes, big business, but I mean, big business is not this, I mean, it's not this unknown entity. That means a lot of people work for big business, right, and they all benefit. And then there's the multiplier effect that for every one job in a typical heavy industry, for every one job directly related to a particular project, you're going to see the add-on effect of 2 to 3 jobs into the community to service those jobs.
Yeah, that's
so it has a
that's a nice return on investment. Stephen, look at oil
indeed.
today. Where do you expect it by year end?
By year end, certainly, I've been, Maria, the past 2.5, 3 years, I'm going to stick by it. Mid-40s on the low end, high 50s on, mid-50s on the high end. Certainly, I like it. You know, I like it right around $50 here. As I said, in the near term, 47, 45 has to hold. If it does not hold, especially at this time of the year, guys, crude oil demand's at its weakest. Refineries are in their turnaround, their maintenance season. In the next couple of months, we're going to add 1.5 million barrels of demand to the market by the time we get into June, July. If oil cannot rally here, then my lower expectation of $45, $46 will have to be revisited, because we'll certainly probably see oil back below $40 handle if OPEC does not get its handle act together.
All right.
But again, mid-40s, high 50s, so it's kind of a punt, but I'll say $50.
Stephen, we're happy you made it. Thanks so much for joining us. Stephen Schork joining us this morning on oil.